Welcome to this Killik Explains finance video. This week, investor behaviour, how loss aversion can hold investors back. What is it? Why does it hold you back? And what, if anything, can you do about it? So basically, the background is what? Well, most humans, and therefore investors, who are normally the same thing, are programmed not to suffer losses. Say normally the same thing because of course there's a lot of machine trading out there, which isn't human, but let's leave that to one side. The humans in the market are programmed not to suffer losses. Why? It's not entirely our fault. And it goes back to life on the savannah, as I'll mention in a moment. It goes back thousands of years in human evolution, but it can limit our long-term returns. It can actually limit our ability to see the wood for the trees and actually devise and stick to a strategy that's good for us in long-term investing terms. So, the observation, by which I mean, where am I getting this stuff from? Well, basically, we tend to feel more pain from losses than we get pleasure from gains. There have been countless studies done by Kahneman, amongst others, that demonstrate that. This is actually evolutionary, so if you're thinking that's not me, well actually to an extent it's hardwired into you, whether you like it or not, because on the savannah we had to conserve existing resources. You go back thousands of years and the human brain hasn't evolved as quickly as many people think it has. Technology may have evolved, but that's not the same thing as saying we have evolved to keep up. All right. So basically we are programmed to conserve resources, all right, rather than go out and find new ones which involve the risk of injury, danger, leaving the cave, leaving the tribe, and so on. So, there's one point. Here's a bit of maths. If you're thinking that's all a bit wishy-washy, here's some maths as to why we don't like losses, or rather, we feel the pain of a loss more than we enjoy the benefit of a gain. So, very simple maths. You start with £100. You make a £20 gain. Happy days. All right? Now, it doesn't take a rocket scientist to say in percentage terms, that is 20%. Well done. Now, if you lose £20, starting from a base of 100, so you've only got 80 left, wait a minute, so you made 20 the last scenario, now you've lost 20, you actually need to make a 25% gain to get back to where you started from. So the percentage magnitude to get back to break even is a bit higher. So there's a sort of logical, mathematical reason why losing money feels more painful, if you want to see it that way. And then there's the sage of Omaha, as he's known, Warren Buffett. And he said, rule number one, when you're an investor, and this has been misquoted and misinterpreted, is don't lose money. Rule number two is follow rule number one. So you've got one of the most successful investors in the world ever telling you, do not lose money. So you've got your evolutionary hardwiring, you've got the maths of it, and you've got some big hitters telling you not to do it. No wonder people are a bit paranoid about losses. And that is fair enough, you might think, but it does set you back in long-term investing terms. So, an obsession with loss aversion, which is what I've just suggested we have, can lead to what? Well, basically, market timing. So paranoid that the market might be about to turn down at any moment, people park themselves in cash, then sit on cash for too long, worrying about whether they've caught the bottom of the market and should go back in again. And we all know, I've quoted it enough times from JP Morgan studies, that the problem with doing that is when the market dips sharply, it often recovers straight afterwards pretty quickly and pretty sharply. And if you miss those so-called best investing days, you seriously dent your subsequent long-term returns. And there aren't many of them, so if you miss them, you're in trouble. And a failure to exploit the power of compound growth, because the longer people sit in cash, worrying nervously about what might happen next, the less opportunity they have to get the kicker that comes from deploying capital early and building, letting time work its magic in terms of interest on interest, as I've explained in other videos. And besides that, you have to ask the question, this is what I mean by Warren Buffett's rule number one being misquoted. What is a loss? What do you mean by a loss? Don't lose money. So, here is a hint at the answer. Real returns, that's post-inflation returns, 1965 to 2015. Now the past is no promise of the future. You can lose money in shares, but here's the picture from the latest Barclays Equity Gilt study. Shares, the best part of 5% over that period. Gilts, a chunk behind that, that's government IOUs, and cash, languishing way back in third position. So now, how safe is cash? what is a loss? Isn't a loss achieving that when maybe with a following wind and the right behaviour, you might have got closer to achieving that? Suddenly, what do we mean by losses? Don't lose money. Okay, cash over time. You've seen this before if you watch my videos closely. The purchasing power of £100. In other words, put £100 in the top drawer, leave it there, take it out again, see what it'll buy. Shocking thing is that between the mid-70s, going back away, and today, your £100, all right, taken out of the top drawer, will actually buy a fraction of what it did in 1976. So that's the point. So now, what do we mean by don't lose money? Sitting on cash is not a way to avoid losing money. So that begins to make us think that risk needs to be defined a little more carefully. So what people often do is they will risk is the problem of things going down as well as up. So shares are incredibly risky. And in the short term, they certainly can be. But over the long term, Barclays are suggesting they might be a better home for your money than cash. So risk is the idea that you don't want to lose purchasing power over time. In other words, if your strategy will simply mean that inflation beats you when you get to your final goal, whether that be some form of retirement or whatever it happens to be, you've kind of lost in a way. So assets that fail to deliver this carry the highest risk. Now that's not to say you pile into shares hoping to make a quick turn and pile out in a year's time. That's madness. Then you will probably suffer a short-term and a long-term real loss if your market timing's bad. We talked about not market timing. This is long-term stuff. Whereas volatility is the price. Volatility is the price you pay. There isn't any volatility in cash per se, but there is in things like shares. It's the price you pay to get that long-term increase in your overall purchasing power. Big caveat coming up, with the right approach. Okay, so that only becomes a risk if you don't take the right approach. And there it is. Past is no guide to the future, but here's the point. Over the very long term, this is the FTSE All-Share total return, so that's dividends reinvested, £1,000 in 1971 via some pretty big drawdowns or dips, if you want to see it that way. Could have become around 112,000, I know it's before costs and so on, in April 2019. The numbers are much less important than the scale of the potential opportunity here, all right? But in the meantime, point I've made before, you have to avoid getting that wrong, and that is about planning more than it is about the behaviour of stock markets. No panic selling, no force selling. Conclusion, therefore, is what? You do need to avoid long-term capital destruction. That is Warren Buffett's rule number one, if you like. He is a long-term investor, one of the longest-term investors we've ever seen in some ways. But don't try to eliminate risk, all right? Don't lose money. It doesn't mean sit in cash and plan to retire 40 years later, because you'll be a lot poorer if you do that. Get your approach right. Get your 3 buckets set up, rainy day fund, lifetime savings. I've talked about this before. Identify where you need to make capital drawdowns and plan your asset allocation accordingly. All right. In other words, identify, map out your life plan, get the 3 buckets sorted, the rainy day fund that's going to stop you liquidating other assets in an emergency, lifetime savings that travel with you and subsequent generations in your family potentially. Those can be invested in something that will hopefully deliver purchasing power increases over time, and then make sure you identify these drawdowns and you've got a strategy in place to liquidate what you need to meet them. In other words, be systematic. Don't be at the mercy of the market's gyrations. Any questions? editor@killik.com. And if you're thinking, where are those videos you talked about where I address some of these topics again, then it's killik.com/learn. And a good place to start would be the Investing Principles tab, kind of over here, or the Shares tab a bit further up.